Hello, all. Happy evening. Hope you are all doing good and the preparations are going in full swing. So, we at Hari Academy are doing the Super 30 batch to boost your last minute preparations. So, the Super 30 question, the agenda or objective is to give you different types of questions from each chapters so that you get the last minute push to your preparations. That is the entire agenda behind the Super 30. So, before this, we have uploaded 3 videos. First one is the amendments video. Second is the first part to the Super 30 questions. Second part is the second video. Third video is the second part of the Super 30 questions. Now this is the third part to the Super 30 questions. In this video, our prime focus is on to finish the PGBP chapter. So totally there are 3 types of questions which may be expected from the PGBP chapter. There are different types of questions. So a normal question as to what is an allowable expenditure and disallowable expenditure, that question is already solved in part 2 of this video. This is part 3. Here our objective is to find out the income from PGBP. There are 2 methods, so we'll just focus on both of that and we'll solve one firm question. And in the subsequent videos, we'll discuss about the capital gains and other important chapters. Right. So let us directly jump into solving the questions. So if you want the PDF version of this, there is another way to get it. So what you can do is you can go to the Hari Academy website, Hari Academy cacmacs.in. You can go to this website. Sorry, it is Hari Academy cacmacs.in. You can go to this website, Hari Academy cacma.in website, and here in the free resources tab, you have this Super 30 questions. In this free resources tab, you have the Super 30 questions. You can just download this from here. Okay, this is a way you could get the Super 30 questions. Now let us go to Super 30 questions. Till question number 8, it is already solved. We have already solved questions till question number 8 in part 2 video. Now we are going to get into part 3 video. Right? In this question, in this, our major focus is to finish the PGBP problems. Okay. So as far as PGBP is concerned, generally there are 3 types of questions. There are 3 types of questions. The first question is a simple question or concept based question. First is a concept based question. In this concept based question, generally you will be getting questions such as compute depreciation, then like whether a deduction expense is allowable or not, that type of questions. Then what is the deduction for scientific expenditure, those types of questions. Then what is the disallowance. So each section they will ask a specific question, that is a concept based question. Second type of question is find income from PGBP. And they'll give you the profit and loss account. And from net profit, you have to find out the income from PGBP. From net profit, you have to find out income from PGBP. The third type of question is again to find income from PGBP. But in this, they'll not give you profit and loss account, but they'll give you the receipts and payments account. In this type of question, there will not be any P&L, but you first have to find out what is the accounting profit, or you can directly find out what is the income tax profit. So first type of question, there is not much discussion which is required. So in second type of question, generally what will happen is, if they ask you to find income from PGBP, and they have given you profit and loss account, The format for getting the answer is as below. First, you have to start with net profit. First, you have to start with net profit. So from this net profit, there are going to be two additions and two subtractions. Okay. So the first addition is expense allowed in accounting, expense allowed in accounting, not allowable in income tax. In income tax. This is the first type of disallowance. Second addition is income not credited to P&L, not credited to P&L, but taxable under the head PGBP. This is the second addition. The first subtraction is expense not debited to P&L, not debited to P&L, but allowable as expenditure in income tax. In income tax. This is the first subtraction. And the second subtraction is income credited to P&L, income credited to P&L, but not taxable, or not taxable, that is in the entire act, or it is taxable under other heads of income. It is taxable in other heads of income. Other heads of income. This is the second subtraction. So if you do two additions and two subtractions, what will happen is you will be getting the total amount of profit. Right? Just a minute, I guess there is some problem. Yeah. So you will be getting the income from PGBP. This is the format. Income from PGBP. We'll get income from PGBP. Right? So you have to start with net profit. To the net profit, you have to do two additions. First addition is expenses which is allowed in accounting. Expenses which is debited to the P&L account, but which is not allowable as an expenditure in the income tax, that is to be added. And income which is not credited to P&L account, but it is taxable under the head PGBP, that amount is to be added. There are two subtractions which is to be made. First one is expenses not debited to the P&L account, but allowable as expenditure as per Income Tax Act. Second deduction is income credited to P&L account, which is not taxable in the entire act itself, that is, it is an exempt income, or that income is not taxable under the head income from PGBP, right? And it is taxable under some other income, such as it is taxable under the head capital gains or income from other sources, something like that. Okay. Now let us get into the question to understand this type of a question. So in this question, if you see, from the following particulars of Mr. Sri Sanju, for the year ended 31st March 2025, find out the business income for the assessment year 25 to 26. For the assessment year 25 to 26. So what has happened here? So generally, if you have to solve a PGBP question like this, your approach should be to read all the items sequentially and solve the answer rather than doing it the other way around. Don't try to go stepwise in the answer. You should go stepwise in the question. I'll tell you how. See, assume for example, you have question number 9. Okay. So first is serial number, particulars, note number, amount in rupees, again amount in rupees. Okay. So first, in case of this types of questions, what you have to do is first start with net profit. Net profit as per P&L account. So this will be your starting point, correct? So you have to open everything. So first put add expenses not debited to P&L. Sorry, expenses debited to P&L, not allowable as expenditure. Not allowable as expenditure. This is going to be our first addition, right? Just open and leave it. This is how you have to solve it in the exam also. Just do it this way, the same method in which I'm doing. Next is add income not credited to P&L, not credited to P&L, but taxable under the head PGBP. This is going to be my second addition. Next, third is less. Less in expenses not debited to P&L, not debited to P&L, but allowable as expenditure. Allowable as expenditure. This is the third less. Fourth less is income credited to P&L, income credited to P&L, but not taxable under PGBP, under PGBP. This is my fourth. So here you'll get the total. This is how we have to solve. Once you see this type of a question, first to open a format like this. Okay. After that, what you have to do is you have to read each and every line item and determine if there is going to be any adjustment on this or not. Okay. So first, let us start from the credit side. So first one is gross profit. So gross profit, we do not have any problem. This can be as such. Second is recovery of bad debts. It is disallowed in the earlier previous year. This is disallowed in the earlier previous year. Okay. Second point is by income tax refund. So if you see the income tax refund, it is not taxable under the head PGBP because it is in the nature of capital, or it is not related to the business income. First of all, that is not an income at all. So whatever you have paid, that amount alone you are getting it as a refund. So this is not even a income which is to be taxed under the head PGBP, right? So income tax refund, it is credited to P&L. Income credited to P&L but not taxable. So first item here will be income tax refund. Income tax refund. So income tax refund of 12,000 is to be subtracted. Right. Next is profit on sale of long-term investment. See, as far as long-term investment is concerned, it is taxable under the head capital gains. It is not taxable under the head PGBP. Hence, this should also be subtracted. Right. Profit on sale of investment. Profit on sale of investment. This is to be subtracted. Again, 40,000. Okay. Next point. Sundry receipts, we do not have any problem. This recovery of bad debts alone, let us just keep it on hold. There will be some adjustment in relation to this because there is some notes in relation to this. Okay. Second, now come here. Wages and salaries, we do not have any problem. Legal expense, no problem. Bad debts, no problem. Rent, no problem as of now. Okay. Next is depreciation. See, in all your questions, the depreciation, whatever is given in the question is as per Companies Act, or it is not as per Income Tax Act, and this is to be disallowed. Depreciation which is computed as per section 32 alone is allowable as expenditure, and any depreciation which is given as per books is to be added back. So depreciation is to be added back. It is an expense which is debited to P&L, but it is not allowable as expenditure. So this amount is to be added back. It is rupees 6,000. Next, to income tax. Income tax expenditure is not allowed as an expenditure in income tax. So this is again, it has to be added. This 2,000 is to be added. Third point is advertisement, no problem. Entertainment expenses, no problem. Purchase of machinery for scientific research. Since this is for scientific research, 100% it is eligible for deduction. Okay, so there is no problem in this. Next, charities and donations. Charities and donations, it is not an allowable expenditure because that is not pertaining to business. Charities and donations. This is not an allowable expenditure because this is not in relation to business. Hence, it is not allowable under section 37. Hence, this has to be added back. 10,000. Next, audit fee, we do not have a problem. General expenses, no problem. Next is extension of building. This extension of building is a capital expenditure. Any capital expenditure is not allowable as an expenditure under section 37. Hence, expansion of building is not a allowable expenditure. This is to be added back to my net profit. Okay, this is 35,000. 35,000. Okay. Next is compensation paid to retrenched employee. This is an allowable expenditure. There is no question to it. Now let us come to the adjustments which is given. The first one is rupees 24,000 in the item of rent. Rupees 24,000 is included in respect of the rent of the office building which is owned by Sanju. So this amount, it is not an allowable expenditure because it is paid to himself. So this rent is not allowable. This has to be added back. Second, in the amount of salaries, rupees 5,000 is included in respect of employer's contribution to recognized provident fund. If you see in relation to the recognized provident fund and any provident fund for that matter, there is a disallowance clause. There is a disallowance clause which will state that in respect of employee's contribution, if it is not paid within the due date, it is disallowed. In respect of this is due date as per PF. If the employee's contribution to PF is not paid within the due date, it is not an allowable expenditure and hence this amount will be taxable. However, employer contribution, if it is within the prescribed limits, it is allowed as expenditure, provided it is paid within 139(1) due date. 139(1) due date. This is given in section 43B. Okay. So in this case, we are making an assumption that it is paid within due date. What you have to do is, for a PGBP question, whatever amount is being added or subtracted, everything should come in notes. So I'm not putting those notes here for want of time, but you have to explain for each and every item why this is being added or why this is being subtracted. Okay. So just to give you an idea of how this format entirely works is, see, you remember the concept of BRS. Whatever we have studied during the +1, +2 stages, we have studied the concept of BRS. So what we will do is, we will take the bank account balance as per accounts, as per books of account, and we will reconcile that with the bank account balance as per bank statement. That is the purpose of BRS, right? Now what we are doing is, we are doing something very, very similar to BRS. So we have the net profit as per P&L account. See, everybody is now on the same page that income tax profit will not be equal to the books of accounts profit. Income tax profit will not be equal to the books of accounts profit. Everybody is on the same page in this respect. So what we are doing is, we are taking the books of accounts profit and we are doing multiple additions and subtractions to arrive at the income tax profit. We are doing multiple additions and subtractions to the books of accounts profit to arrive at the income tax profit. That is the idea of this entire format. Okay, this is how this question has to be solved. So for every addition and subtraction, you just need to mention why it is being added or subtracted. Okay, now let us get back to the question. Third point is, closing stock is valued at cost while opening stock is valued at 25% above cost. Value of opening stock taken in trading account is 2 lakhs. This requires a bit of discussion. Notes. Let us go to notes. You have to do this for everything. I am doing it only for opening or closing stock. Let us understand the concept here. See, as we all know, stock should be valued at lower of cost and NRV. Okay, this is the norm everywhere. This NRV is, even if it is higher, we do not have a problem. Whatever is lower, in that we have to value the cost. We are on the same page. If the stock is overvalued or undervalued, first we have to find what is going to be its impact in the net profit, and that has to be set right. So first we have to find out what is the effect on book profit. This undervaluation or overvaluation of stock, undervaluation or overvaluation of stock has a direct bearing on P&L account net profit. Correct? So what is our point is, so we have to remove the effect of this. Remove the effect of this wrong reporting. See, very simple. This is your profit and loss account, for example. Okay. So our starting point is going to be opening stock. By opening stock, assume, say this is 1000. For example, all these figures are imaginary. Okay. So here to closing stock, we are putting 500. And just to sales, I'm not having any other thing for sake of convenience. To sales, 2500. So this is going to be 2500. Then my gross profit is going to be 1500. This 1500, assuming this is trading account, then P&L account. In P&L account, my to gross profit, it is going to be 1500. And there are going to be multiple expenses, and we are going to have by net profit some amount. Say for example 1000. Okay, so all these things put together, it is 500. Any expense. This is your profit trading and profit and loss. Assuming if your opening stock is overvalued, if your opening stock is overvalued by rupees 500, assume opening stock is overvalued by rupees 500. Now what will happen? All the other figures remain the same. So this is going to be 1500. So to sales, it is going to be 2000. To closing stock, this is going to be 500. This is 2500. And your gross profit is going to be 1000 rupees. Then this gross profit is going to come to your net profit account. So net profit is going to be 1000. And any expenses, all expenses to 500. Then your net profit in this case is going to be 500 rupees. So if the opening stock is overvalued or undervalued, or your closing stock is overvalued or undervalued, that amount is going to have a direct bearing on your net profit. So whatever is the difference which is arising due to this overvaluation or undervaluation has to be removed in entirety to arrive at the proper profits. In income tax also, stock is to be valued at lower of cost and NRV. There is no doubt to it. It is to be valued at cost. If it is overvalued, the effect has to be removed from net profit. Okay. So now let us understand how to remember this. This is a remembrance. This is the logic. So if you see here, this net profit is 500. Here the actual net profit is 1000. Okay. Because of this difference, because of this overvaluation, the revised net profit what we have got is 500. So this difference 500, where it is coming is, it is because of this overvaluation of rupees 500. This 500 is coming here. The 500, which is the difference between the actual net profit and the revised net profit, it is fully attributable to overvaluation of the opening stock. This is the point. Okay. Now, what to do? Sir, all these things are fine, sir. What should I do in exam? What should you do in exam is? I'll tell you now. Opening stock, closing stock, overvaluation, undervaluation. This is what you have to do. So if you are going to start from P&L, this is the operation you have to give. So what is here? In this case, opening stock is overvalued to the extent of rupees 500 rupees. So if opening stock is higher, my net profit is going to be lower. If opening stock is higher, my net profit is going to be lower to that extent. Hence, overvaluation of opening stock is to be added. Overvaluation of opening stock is to be added to the net profit to derive at the income tax profit. Let me repeat it again. Overvaluation of opening stock is to be added to the net profit to arrive at the income tax profit. You remember this one point alone. Overvaluation of opening stock is to be added to the net profit to arrive at the income tax profit. This is the only mantra. All the other three is balancing figure. See, if overvaluation of opening stock is to be added, then undervaluation of opening stock is to be subtracted. Opposite. Similarly, if overvaluation of opening stock is to be added, overvaluation of closing stock is to be subtracted. If overvaluation of closing stock is to be subtracted, then undervaluation of closing stock is to be added. That's it. This is the point. Overvaluation, undervaluation, this is the entire thing which you have to do to the net profit. This is the operation. The logic I just explained, this is the operation what you have to do. Okay, just remember this. Read this before you go to the exam. This should do. Don't by heart all the four things. Just by heart this one alone. Overvaluation of opening stock is to be added. Overvaluation of opening stock is to be added. All the other things are balancing figures. So if overvaluation of opening stock is to be added, then undervaluation of opening stock is to be subtracted. If overvaluation of opening stock is to be added, overvaluation of closing stock is to be subtracted. If overvaluation of closing stock is to be subtracted, undervaluation of closing stock is to be added. That's it. If you remember this one alone, if you remember only one point, if you remember this alone, that should do the job for you. This alone you remember. Overvaluation of opening stock is to be added. All the other things will fall in place automatically. Okay. Now let us get back to our discussion of question. In this case, what has happened? Closing stock is valued at cost. No problem. Opening stock is valued at 25% above cost. Opening stock is valued at 25% above cost. So what is the value of opening stock which is taken in the trading account is rupees 2 lakhs. So now what we have to do? So value in trading account is 2 lakhs. So this 2 lakhs, it is for 125%. We have to find what is for 25%. So what you have to do is, this is 40,000. So this 40,000 is the effect. This 40,000 is to be added. 40,000 is to be added to your net profit. This alone I'm just adding it as a separate line item. Add overvaluation of opening stock. Overvaluation of opening stock, 40,000 is to be added. Okay. Now let us go to the next point. Bad debts include rupees 10,500 due from one customer who is solvent, and no legal step has been taken to recover that amount. See, in respect of bad debts, we do not have any problem as to whether it is actual bad debt or not, whether we have taken any step to recover or not. If it is recognized as bad debt in the books of accounts, that is fine, and that has to be treated as bad debts. So there is no adjustment which is required for this. Next, legal expense include rupees 900 for GST appeal and 2000 as penalty for infringement. So any penalty for infringement of anything, it is disallowed expenditure under section 37. This is a new amendment, so this has to be added. So this penalty of rupees 2000 has to be added. This penalty of rupees 2000 has to be added. Next, advertisement expenses include rupees 4000 spent for purchasing presentation articles for distribution to the regular customers on New Year's Day. This is a allowable expenditure. There is no bar on it. Next point is he owned the following assets as on 1/4/2024. So now we have to compute depreciation as per Income Tax Act. Now we have to note number 2, computation of depreciation. Note number 2, depreciation as per Income Tax Act. Income Tax Act. So you already know our method for computing depreciation will be opening WDV plus purchases made during the year plus purchases minus sale value, that is monies payable. This will give you the WDV. This WDV you have to charge the depreciation rate into rate of depreciation. Rate of depreciation is going to give you the depreciation, and this has to be subtracted. This depreciation has to be subtracted, which will give you the closing WDV. Closing WDV. This is the point. Okay. Now let us find out what is the thing. So has the following assets. So first asset type is building. Second asset type is machinery. Third asset type is furnitures and fixtures. Furnitures and fixtures. Okay. Here they have given the opening WDV points. So opening WDV of building is 1,60,000. 1,60,000. Next is opening WDV of machinery is 1,20,000. And furnitures and fixtures, it is 50,000. Okay. So as far as purchases are concerned, we have already seen here that extension of building is there. This is an addition which has to be made. So purchases 35,000 for building. There is no other purchase. There is no other purchase. Okay. So the revised WDV, it is going to be 1,95,000, 1,20,000, then 50,000. So as you all know, if the purchase is put to use, if it is put to use for less than 180 days now, only 50% is allowable. Yeah. But in this case, we are making an assumption. If the date of purchase is not given, you make an assumption. And the easier assumption to make is, it has been assumed that extension is put to use for more than 180 days, 182 days. Okay. So in this case, there is no problem. So we can charge the rate at full. So here they have also given the rates of depreciation. So for building, it is 10%. For plant and machinery, this is 15%. And for furnitures and fixtures, it is again 10%. So this is going to be 19,500 plus 12,000 plus 5,000. So the total is going to be, it is 17,000. Then we have to add this 19,500 to the 17,000. So the total is, wait, let me just put the total, 19,500 plus 12,000 plus 5,000. So this is going to be 32,000. Okay, am I missing something? I don't think. Machinery. So here for the rate is 15%. This is not 10%. So this is 18,000. This is 18,000. So the total amount is going to come to somewhere around 42,500. This is the allowable. Wait a minute. Just give me a minute. Just a minute here. My screen has some problem. Yeah. So income expense is not debited to P&L but allowable as expenditure. It comes depreciation. Depreciation. This is 42,500. So let us check if there is something else which has to be treated properly. So as far as this recovery of bad debts is concerned, since this is not allowed as expenditure in the previous year, this has to be deducted. Okay, this is not taxable. This amount, it is not taxable because this is not already deducted as allowed as deduction in the previous year. Recovery of bad debts is taxable only if that bad debt is allowed as an expenditure in the previous year. Since this is not allowed, this is not taxable. Hence, this bad debts should be subtracted. Bad debts should be subtracted to the extent of 5,000. Now let us do the computation. Right. So first we have to take 267,500, 267,350. So here the amount is 267,350. So to this we have to add 6,000, add 2,000, add 10,000, add 35,000, add 24,000, and add 2,000. And you have to subtract 42,500, 5,000, 12,000, 40,000. And you also have to add this 40,000. So if you do all these adjustments, our total income is going to come to somewhere around, so 267,350 plus 6,000 plus 2,000 plus 10,000 plus 35,000 plus 24,000, 2,000 minus 42,500, 5,000 minus 12,000 minus 40,000 plus 40,000. So the total is going to come to somewhere around 286,850. So my total income from PGBP is 286,250. 286,850. This is my total income from PGBP. Total income from PGBP. Okay. Hope this question is clear. This is a type of question where we start from book profit as per P&L and we arrive at the book profit, income tax profit, and the income tax profit in the present case is 286,850. Okay. Now let us go to the next question. The next question which we are going to deal with is going to have the receipts and payments account, and we have to find the profit. Is going to have the receipts and payment account, and we have to find the profit itself. This is not this the solving of this problem will be different from the approach we have adopted now. We'll just see this question now. So now let us continue to do question number 10. Okay. So as far as question number 10 is concerned, what they have given is they have given the receipts and payments account. So this is not P&L account. So whatever discussion we have done in the previous question, that is not applicable for the present question. That is the beauty of income tax. Right? So each question will be different in its own, and each question has to be done in a different format. You cannot use the same format for everything. Right? So now let us get into this question. So what they have done is, following is the receipts and payments account of CMA Debnath, a practicing cost accountant, for the year ended 31st March 2025. Compute his income from profession for assessment year 25-26. Right. So this question, the methodology we have to solve this, since there is no net profit which is given, the previous question format is not applicable. Okay. So we do not have some net profit to derive at the income tax profit. There is no net profit for us to arrive at the income tax profit. So now what we have to do is, we have to directly find out what is the income tax profit. In this question, we have to directly find out what is the income tax profit. In the previous question, we had book profit. So from book profit, we arrived at the income tax profit. In this question, there is no book profit at all. So what we have to do? We have to independently arrive at the income tax profit. That is the question 10. Question number 10. Okay. So how to solve this question? So any income which is chargeable under the head PGBP is to be added. Any income expense which is to be allowed is to be subtracted. That's it. Easy. Any amount which is taxable, add. Any amount which is deductible, subtract. Close. That's it. Okay. So let us first check the receipt. So let us go by this. Balance, no problem. Next is professional receipts. Is professional receipts taxable? Yes, it is taxable. So first it is serial number, particulars, note number. So this should be your format in every question. Don't change this format. Okay. Amount in rupees. First, professional receipts is taxable. First one is professional receipt. PROFESSIO. Professional receipts. This is taxable. So what is the amount? It is 8,20,000. 8,20,000. 1, 2, 3. Next, fees from accounting works. This is again taxable under the head PGBP. Fees from accounting works. This is taxable under the head PGBP. This is 65,000. 65,000. Third point, salary from a college as a guest lecturer. So this is not a major business or profession. This should be taxable under their income from other sources, because he is a practicing cost accountant and teaching as a guest lecturer is not his business or profession. So this is not even chargeable under the head PGBP, and charging section under section 28 is itself not applicable in the present case. Charging section under section 28 is itself not applicable to the present case. This is taxable under the income from other sources. Did the question ask you to find the income from other sources? No. So no problem. Next, gift from client for appreciation of service. This is taxable. Gift from client. This is 25,000. This is again taxable. 25,000. This is taxable. Okay. Next, interest on deposit, examiner's remuneration from ICMAI. Again, this is not his business, hence not taxable. In the interest on deposit, again, it is not from his business, hence it is not taxable. So all these three, this 1,20,000, this 40,000, and this 70,000, it is taxable under the head income from other sources, and it is not taxable under the head income from PGBP. The question asks us to specifically compute income from PGBP. All these three is not pertaining to income from PGBP, right? So closed it. Next. So this total comes to 9,10,000. This is my total income, 9,10,000. Now let us subtract the expenses. So first is rent. See here, rent and electric charges in respect of house, of which half portion is used as self-residence and the half of the remaining portion is used for his business or profession. So in respect of rent and electric charges, only half is applicable. Next, 1/5 of the motor car are related to personal use. 1/5 of the motor car expense is related to personal use. That is also related to purchase of motor car. Okay. Now let us complete. First is rent. So rent, total rent which is paid is 1,80,000. Of this, only half of the amount is allowable as a deduction. So that is 90,000. 90,000. Okay. Next is electricity charges. Electricity charges. The amount is 12,000. Of these 12,000 also, only half is taxable here. So half is allowable as deduction. So that is 6,000. Third point is remuneration to office clerk. Remuneration to office clerk. So this amount, again, it is fully allowable, 80,000. 80,000. Fourth point is salary to office staff, fully allowed. Salary 1,20,000. 1,20,000. Then life insurance premium. This is not life insurance premium. It is allowable as deduction only under section 80C. This is PGBP. In PGBP, that is not allowed as a deduction. So this life insurance premium of 15,000 is not allowed. Miscellaneous office expenses is an allowable expenditure. Miscellaneous office expenses is an allowable expenditure to the extent of 8,000. Next is purchase of motor car. See, in respect of purchase of motor car, this is a capital expenditure that is not allowed, but depreciation is allowed. Depreciation for purchase of motor car. So here, purchase of motor car, the total value is 3,50,000. 3,50,000. The rate of depreciation for purchase of motor car is 15%, and 4/5 of it is alone relates to the business. 1/5 it is for his personal purpose, so that is not allowed. So 3,50,000 into 0.15 into 4/5. So total 42,000 is allowable as depreciation. 42,000. Next is motor car expenses. Motor car expenses. As far as motor car expenses is concerned, again 4/5 is allowed. 75,000 into 4/5, 60,000. This is allowed as expenditure. Next is membership fee, fully allowed. Membership fee. This is fully allowed, 1,500. Then household donation to a recognized university. This is not an allowable expenditure. Household expenses is not an allowable expenditure. Journal, it is an allowable expenditure. Purchase of professional journals. Purchase of professional journals. Purchase of professional journal, 10,000 is an allowable expenditure. 10,000. It is an allowable expenditure. Right. So this one we have taken care of. This one also we have taken care of. Right. So let us do the total. So it is 90,000. 90,000 plus 6,000 plus 80,000 plus 1,20,000 plus 8,000 plus 42,000 plus 60,000 plus 1,500 plus 10,000. So the total expenses comes to 4,17,500. So my income from PGBP comes to, so from this 4,17,500, we have to reduce 9,10,000. So the total amount is 492,500. 4,92,500. This is income from PGBP. Right. Now let us go to this. With this question is completed. Right. This is a type of question where we start from receipts and payments account. We find the income. This is different from first question because we do not have a net profit. We have to compute the income tax profit directly. We have to make certain assumptions here. It is assumed in this case that he is following cash basis of accounting. So this question is correct only if you give this note that it has been assumed that he is following cash basis of accounting. This is a very important note. Very, very important note. You have to state that it has been assumed that he is following cash basis of accounting. Very, very important in the examination. Okay. Now let us go to the next question. Question number 11. So this is the last question in relation to PGBP. Okay. Simple. This is in relation to firm. Super. As far as firm is concerned, you have to remember 2 points. First one is the interest point. See, interest, if it is allowed as per your partnership deed, you can claim that as deduction, provided it does not exceed 12%. Provided it does not exceed 12%. Next point is remuneration. Remuneration, we have already seen the limits. Where we have seen the limits in the amendments video, we have discussed that in very detail. We have seen the limits. That is also applicable only if it is allowed in the partnership deed. It is allowed in the partnership deed. Partnership deed. This is already there in the amendments video. You can go and check that amendments video. Okay. Now let us compute the total income. So how do we start here? So we have net profit. So if there is net profit, always start from net profit. Question number 11. Question number 11. Serial number, particulars, note, amount, and amount. Okay, first is net profit. As always, do the net profit. Net profit. So in this question, if you see, there is gross profit, interest on bank, then there is salary to partners, interest on partners capital, depreciation is there, sundry expenses, net profit is there. So depreciation as per IT rules, they have given it as 4,60,000. Okay, here books depreciation is 4,40,000 and sundry expenses has 14,000 of fine in it. So we have to find the total income of the firm and total tax liability of the firm. This is the requirement. Okay. So first let us start with the net profit. So net profit is 80,000. 80,000. See, the same format which we used in question number 9 is applicable here. But since this has very short adjustments, I am using a very simple format. I am using the same adds and subtracts only. I am not opening all the 4 things. So first one is add. Expenses debited to P&L. Debited to P&L. Not allowable. Not allowable. Okay. So the first one is all the salary. So what you have to do is, to find what is the amount of remuneration which is allowable, first you have to find out the book profit. So to find out the book profit, what you have to do is, you have to find the profit before remuneration. Profit before remuneration. All other expenses should be given. Profit before remuneration should be there. So first what you have to find is, to find out the book profit, we have to add back remuneration. Remuneration. So remuneration is 4 lakhs. Next is interest on capital. Interest on capital, only up to 12% it is allowed. So remaining 3% you have to remove. So this 1,20,000 is for 15%. Then what is it for? So that amount, the amount which you are going to add here is just the disallowance. So okay, so 12 to 15, the difference is 3. Okay, so it is going to be 1,20,000 divided by 5. So 24,000 is not allowed. 24,000, right? Then depreciation, as usual, depreciation. This is again not allowable as an expenditure. This 4,40,000. 4,40,000. 40,000 is not allowable because depreciation as per Income Tax Act alone is allowable. Then less, we have depreciation as per Income Tax Act, depreciation as per Income Tax Act. So this is for 4,60,000. This is for 4,60,000. Then this penalty for any penalty, now it is not allowable as an expenditure. So this 14,000 also should be added back. Now let us find out what is the book profit. What is the book profit? So this is one step which will be there only in firm question. This is one step will only be there in firm's question. We have to find out the book profit for the purpose of to compute the remuneration allowable. Okay. So in this case, what you have to do is you have to take 80,000 plus 4 lakhs plus 24,000 plus 4 lakhs 40,000 plus 14,000 minus 4 lakhs 60,000. So your book profit is going to come to somewhere around 8 lakhs, just give me a minute, 80,000 plus 4 lakhs plus 4 lakhs 40,000 plus 14,000 plus 24,000 minus, then you have to remove this interest also. This is to be removed. Interest, this is also to be removed. Interest of 1,40,000 has to be removed. Minus 1,40,000 minus 4,60,000. So this will give you 3 lakhs. The book profit in the present case is going to be 3,58,000. Book profit is going to be 3,58,000. 3,58,000. Right? So for in this 3,58,000, we have to find out what is the, so up to first 3 lakhs, we have to find out what is the amount of this. To 3 lakhs up to 6 lakhs of profit, it is 3 lakhs or 90% of book profit. 90% of book profit. So if you see in for 3,58,000, the 90% of book profit is 3,22,000. So this 3,22,200 is the allowable expenditure, allowable remuneration. So how they divide between both, three of them is not the question which is there in our hand. So just if we say that this is an allowable expenditure, that is fine. Okay. So now we have to compute the income from PGBP. PGBP. So 3,58,000 minus 3,22,200. So income from PGBP is 35,800. Okay, so to this we have to add income from other sources. Income from other sources. This is to the extent of 1,40,000. So the total income of the firm. Total income of the firm is rupees 1,75,800. 175,800. This is the first part. Next, we have to find out the tax liability. Tax liability of the firm. We have to find out the tax liability of the firm. So as far as tax liability of the firm is concerned, it is taxable at 30%. So the tax liability is 52,740 before cess. So if you are going to add cess to this, the total tax liability is rupees 53,268. Sorry, I'm just reached 52,740 into 1.04. 52,740 into 1.04, and this gives you 54,850. 54,850 is the tax liability of the firm, right? That's it. With this question also comes to an end. So in this video, we have discussed fully about the questions, 3 types of questions in relation to the PGVP chapter. In the subsequent videos, we'll discuss about the other chapters. Okay, so whatever doubts you have, feel free to come and reach us in the comment box. And if you have any other questions or you want something else from us, we'll be very happy to support you. Please let us know in the comment box. Thank you. Bye bye. All the best for the preparations.